We are back with a little bit more data and survey results and context. So I didn't get to introduce myself. No one did, but I'm part of Bloomberg Intelligence. We are the in-house investment research team within Bloomberg. We are a team of 500 analysts, associates, and editors across all the regions in the world, including mainland China, including Brazil now. I just wanted to share something with you which is hot off the press. So this came out right this morning. We conducted a survey of 600 plus respondents across different industries to assess what was the real impact of AI in their industries. And there's a lot of hype around the AI bubble, around what AI can do. The biggest fear is, will there be a lot of job losses? Which industries are more vulnerable, blah, blah, blah. We wanted to really quantify that. And that's what my department does. We do data-based investment research. 150 participants out of these were from financial services, and that spans across insurance, asset and wealth management, commercial banking, investment banking, fintech, and payments. Most of this cohort, about 80% plus, was C-suites, with the remainder serving as senior directors or above across these organizations. So this really is the real picture of what companies are thinking about AI adoption and where they are. To give you a sense of the size of the companies that we connected with, 50% plus were firms with 5,000 to 10,000 employees. 30% of them were 10,000 to 50,000 employees. And 16% companies were over 50,000 employee base. And geographically, 40% were North America, 50% were Europe. So about 70% of financial institutions saw 1 to 10% revenue growth, while roughly 74% project a similar rise in profits. And if you think about it, this basically suggests very minimal operating leverage. If you have the same amount of translation of growth in revenue and profit. And what that means is that AI basically stands to benefit companies on client engagement, on personalization, on cross-selling revenue. Yet, because they're constantly investing in AI, in data technology, in infrastructure, in personnel, the impact on cost is going to be a bit more delayed. And that's what the survey results are kind of pointing to. So we do expect cost ratios to start rationalizing a little bit more as productivity gains materialize after that investment period is over, or at least the investments taper off. And that supports stronger incremental margin benefits beyond 2027-28 across the industry. More than 75% of our respondents expected productivity to rise at least 6%. Yet over 70% also see higher operating costs because of AI deployment. And that's, as I mentioned, because of all the investments in data, cloud migration, AI-related tools, and model governance. The findings reinforce that AI's early phase in financial services is more likely to be about building capability rather than cost reduction. This is a very important chart for a lot of people, and this is something that a lot of people worry. Contrary to popular belief, 2/3 of financial services executives expect headcount to rise over the next 3 years due to AI. More than half of them are planning to add roles as AI compliance specialists, workflow and agent designers, model auditors. So there are new roles that they anticipate creating because of all these investments in AI. And that basically signals a workflow realignment rather than a headcount reduction focus, and rather than basically displacing more people tied to this technology, right? Most foresee a 6 to 10% increase in net headcount. That is the other surprising takeaway from this survey. And that's likely concentrated in the areas around data science, engineering, research, and advisory roles. One thing to note, financial services in particular, the AI adoption curve is a lot more gradual than some of the other industries that you probably encounter, be it retail, consumer, tech. Only 23% of respondents actually report enterprise-wide scaling of AI tools compared to 35% across all industries. And the gap likely stems from overlapping regulatory, data, and risk constraints. There's tighter model governance, explainability requirements by regulators. Fragmented legacy data is a big challenge across the industry. and strict oversight of PII. Anyone who works in financial services here appreciates that challenge. All of these issues limit model training, and the strategies add cost and complexity to model development, whereas risk and compliance caution also slows out your ability to roll out models in real time and go at the pace at which other industries in tech or retail probably go. Operational efficiency obviously is one of the biggest focus why people are investing in AI, and nearly half ranking it as the top objective for their AI investments. Process automation is central, but firms are emphasizing productivity gains, not headcount cuts, with only 15% of these respondents citing job cuts as their primary goal. So people are wanting to do more with less rather than cutting down people in their firms at the moment. At the moment is the main point. Revenue generation and customer experience are following closely. That reflects a broader shift towards using AI to deepen more personalization across your product spectrum, accelerate product innovation, unlock new and digital revenue streams. If you talk to any banks, that's one of the key focus that they have. Here's the interesting part, and I think the audience here will relate the most with this. 40% of financial services allocate 11 to 20% of their annual tech budgets to AI-related initiatives. Payment companies across the financial spectrum lead that. An average of 17% of total spending is dedicated to AI capabilities. Investment banking and wealth management follow closely. Obviously, leaders like Goldman Sachs, Morgan Stanley, BlackRock, they're all making very heavy AI investments. And here's one of the most interesting pieces as well, right? In our view, AI could actually graduate from a cost focus to a margin and monetization lever. And we think that fintechs addressing SMBs are disproportionately positioned to benefit from AI. Why is that? Because all financial subsectors, they're actively pursuing AI adoption, but AI is one of the first technologies that can actually process unstructured workflows and information, and that has been one of the biggest challenges, and I'll talk more about it as we go forward. We expect winning fintechs to adapt AI as a lever to lower cost ratios, faster acquisition. However, companies with lower or thinner data moats, I think those are the companies that are going to struggle in the AI era. I'll delve a bit deeper on why the fintechs we think are better positioned, but just to kind of place the industry context, SMBs are the backbone of the global economy, right? They account for more than half of the global GDP. Over 90% of all companies are SMBs, and more than 2/3 of business employment is through SMBs. Every bank, what their salt will tell you what a lucrative segment this is, how much they want to target it, and yet this is one of the biggest and most challenging segment that banks have struggled to service globally. Manual AR and AP processes dominate financial operations. There's just too much manual intervention, too much inefficiency that kind of is ridden. And that is what makes SMBs challenging. But from the client perspective, quality and cost of labor, as what Mary Kay had pointed out during our panel, it's one of the most challenging parts of SMBs. And collectively, these pain points add to operating cost. They elongate working capital cycles for these companies, and they just keep it's like a chicken and egg problem that kind of keeps self-reinforcing. AI is the first technology that is capable of interpreting unstructured workflows like invoices, like emails, contracts, and that enables automation across AR/AP. Even if the payment itself is digitized, there's just so much manual intervention on both ends of the transaction that it just doesn't make the puzzle piece seamless and flow. Payments and fintechs are shifting from basic digitization to full straight-through automation flows. MasterCard assesses $80 trillion commercial flows as an opportunity, of which $63 trillion is in invoiced payments. When we tie that into the findings of our survey, the fastest areas where it's reaping benefits is around software development and engineering. 66% of companies have talked about scaled or deployed use cases rather than just doing pilots at the moment. Specific to SMB fintechs, AI adoption across these fintechs are centered around 4 high-impact workflows. First is APR automation, which we talked about in the panel today. Second is better risk scoring and underwriting. Access to capital is one of the biggest challenges, and AI can help you resolve that. Third is efficient onboarding and customer support. And all of them are aimed at supporting back office workflows to lift margin and to expand attach rates for fintechs. Picking through some of them individually. So we're picking out some case studies to show what companies are doing in that regard. So with Intuit, their AI bets deserve a mention. Our team thinks that its GenAI assistant, Intuit Assist, should provide a pricing tailwind and increased adoption of live experts that they work on their network. And with an end-to-end solution for small, medium businesses with QuickBooks AP automation, with their HR integration, all of that data comes into one place and you generate predictive insights out of that. That's a very, very valuable asset for SMBs, frees up a lot of time to do more productive things, and also makes it very sticky for Intuit. In this era where fintechs will, this is one space where I think fintechs will actually gain an edge. AI leaders are going to see lesser loss rates and volatility and higher attach rates for working capital. So if you monitor those statistics, you'll see how fintechs keep gaining an edge over banks because banks don't have their data sorted at the moment, at least not the primary banking relationships that you would think that would be targeting that segment. Risk underwriting is going to be continuous and adaptive, and all of the conversations that we had around different data sets getting incorporated in that decision, how much is your AP, how much is your AR, your POS data, accounting feeds, tax information, all of that will become currency to get better credit access and availability for SMBs. Platforms that integrate AI into merchant-facing workflows, they can widen their competitive moats. All of you, this is something to kind of think about. Onboarding and support are one of the areas where we are seeing very early scaled AI benefits. PayPal reported 1.5 times higher average margin per merchant and 2 times more product activations when they start onboarding their merchants with a survey and get to hear what the merchants are looking for and get to know them better at the start. MasterCard leverages AI across several use cases, including decision intelligence, etc. But I think the most notable that I have noticed is on the doubling down on digital identity and trust, where it has made sizable acquisitions, and I talked about Recorded Future. They block billions of dollars of fraud annually through AI-driven solutions, and they've boosted fraud detection rates by 20% to as much as 300%. And lastly, Block. It is positioning Square as an AI-native operating system for small businesses, embedding intelligence directly into merchant workflows. They've launched a LLM-driven tool that automates customer messaging, marketing, etc. The one thing that I really liked was their voice-enabled system, which basically, when I place an order on phone, that message does not get received by a person. It goes directly to their order platform, and the accuracy of that model is so much more better than what we've ever seen in the past, all thanks to AI. To end with, what does it take to win this race? Our survey confirms that doing the hard things will matter the most. Data remains the foundation and primary sticking point for AI adoption across all spectrums of financial services. More than a quarter of the participants identified data quality as one of their most pressing challenge, reflecting the industry's reliance on accurate, well-governed data sets for model reliability and also regulatory confidence. Another 30% ranked data privacy and cybersecurity as their top concerns. So that's what we think data readiness and data strength will determine winners, and it's not about who has the best AI model, but who has their data sorted and organized. With that, I'm on time. Thank you so much. Please reach out to us if you have any questions or you want to access more of this research. We're available on the terminal. Thank you.